Get started with the first conversation of the day, and this has to do with fixed income. I'd like to draw your attention to the benchmark government bond yield. The 10-year bond in 2020, after the onset of the COVID-19 pandemic, fell to record lows of less than 6%. But over the last few weeks and months, you've seen the bond yields rise. In fact, today you had the 10-year bond benchmark bond yield hit 6.59%. And that's the highest, in fact, since 2021, at the start of 2021, if I'm not mistaken. Why is this happening? It's not a phenomenon that's happening just in India. It's happening across the globe. My guest today has those answers and more. Sandeep Bagla, the Chief Executive Officer of Trust Mutual Fund, is joining me now. Thank you so much, Sandeep, for taking the time, and wish you and your team and your family a very, very happy new year. Let's start with the context first, and I guess we'll have to talk about this in two parts: what's happening in the US and the rest of the world, and then what's happening in India. Could you set the context for us as to where we are right now and how we got here?
Thank you, Alex, for having me on the show. The context is that, US is the mother market, even in terms of interest rates. The context is set by the US because most of the QE or the monetary tightening or easing is done by the US, and it's followed more or less with some lags by the other emerging countries or the developed countries. So US has been in the forefront of reducing rate and increasing liquidity for the past few years to fight the impact of COVID. Now they have clearly said that they are going to increase rates, they are going to reduce their tapering, and they are going to also reduce their balance sheet size. Also, what has happened, if you see, is that the inflation has been quite stubborn. In India, the headline inflation has been above 5, and the core inflation has been close to 6. Now, typically, what we have seen that the 10-year yield typically in India trades at about 250 basis points over expected inflation. And if expected inflation is at 5% after 1 year, the fair value of the 10 years should be, by historical standards, anywhere between 7 to 7.5. So we are inching higher. We have not reached the peak by any stretch of imagination. And inflation and inflationary expectations, I think, are the reason why interest rates will go up in the longer end of the segment. The shorter end of the curve, which is, let's say, 1 to 2 years or up to 1 year, is more determined by the liquidity in the system and the marginal rate of repo rate which RBI sets. So since inflationary expectations have been going up with food prices and commodity prices going up, also US is starting to looking to raise rates. There's hardly anything left for the Indian rates but to go up.
Understood. Let's talk about where we stand right now. However, in terms of the third wave, Omicron, it's something that a lot of countries are now contending with. Is it going to be as disruptive as what we've seen in the past? And every time the US central bank has talked about rolling back and tapering the quantitative easing program, something or the other has come up, and it has been forced, in fact, to expand its balance sheet rather than reducing it. Do we see Omicron as something that again puts a spoke in the wheel in terms of raising rates, in terms of putting a curb to what they have finally admitted is an inflation that does not seem to be transitory?
So I think Omicron is very, very infectious, and it's spreading very fast. However, does not seem to have the impact on human lives the way the first or second wave did. So I think the last statement which came out from the US Fed was after the onset of Omicron. So I think after having considered everything, they have embarked on this path of reducing the balance sheet size and increasing rates. So while in India it may delay the rate hike or the change in stance by a couple of months, I don't think in the US they are going to change the course of action which they have taken. However, one must never say never. So it does not it's not unlikely that they have to change course, but I think Omicron will not be able to do the trick.
Understood. And you're referring, of course, to the latest update from the Fed, which was the minutes of the last meeting in December, where they suggested that rates could be increased in a more aggressive manner than was previously thought. I want to turn attention to the Indian scenario now, Sandeep, and you had the advance estimates for GDP come in for the current financial year, 9.2%. I think this is less than what the RBI themselves had forecast, but nominal at 17.6%. Will there be additional pressure for the inflation targeting central bank, the Reserve Bank of India and its Monetary Policy Committee to raise rates? What are your own expectations in terms of increase in interest rates in this current financial year? I mean, in this year and in the next financial year?
So Indian policymakers are torn between two things. One, of course, the high inflation number and the persistence of the core numbers as well. The other is that fact that we have an output gap which is still very wide, and we would want to close that output gap. And one of the methods could be by keeping interest rates low. Now, that output gap, to the best of my knowledge, is not closing down. Now, so it's a matter of choice whether the central bank decides to normalize rates, and I think they have already normalized rates by reducing liquidity in the system. So there are times when the overnight rate goes as high as 380, 390. So I think pretty soon they will officialize it also by increasing the reverse repo rate. But as of now, it seems that they are not really very keen to increase rates because they want to, how they say, boost growth impulses. So right now, they don't seem to be worried about inflation. But the market is certainly turning more cautious about inflation than the RBI, which is why you are saying that the fresh supply of bonds is getting absorbed by the market only at higher and higher rates, because market has to protect itself against impending inflation.
Very true. I want to talk about what is happening on the yield curve, and perhaps I don't know if we can get into the absolute technicalities of how the shorter term rates are being priced. But a conversation that I was having with the Treasury head recently was suggesting, Sandeep, that the RBI is now moving through the measures that it's taking on liquidity to move the anchor of short-term rates from the reverse repo back to the repo. And I think to a certain extent what you were saying, the raising of the reverse repo rate could be along those lines as well. But just so that my viewers understand from the perspective of how they should change their fixed income strategy, where does the yield curve move from here? You see a flattening of the yield curve?
So already the yield curve has flattened quite a lot. So what do we mean when we say flattening? So let's say the 3-year yield curve has moved up by 55, 60 basis points in the last 3 months. However, the 10-year yield has only gone up by 25 basis points. So the yield curve has flattened by almost 30, 35 basis points. So what happens is that all the money in the fixed income markets has moved to below 3 years in the mutual fund space. Most of the money is lying in products which have taken exposure to less than 3 years. However, that is also not getting defended well, because yields are going up much faster in that segment. So I think that while the curve has flattened quite a lot, it cannot be ruled out that more flattening is not possible. So in plain words, yes, flattening is possible. That means short-end yields can go up even more. I do expect the 10-year to first go to 670, 75. So I think another 10, 15 basis points to go on the 10-year. But the short end of the curve is anybody's guess. And I think it is going to move more than the movement shown by the 10-year bonds.
Sandeep, if somebody is deciding which fixed income product in the mutual fund space to choose right now, it's obviously prudent to go in for something like a roll down on the shorter term, right? 3 years or below. But how do you explain that? Can you explain it in simple terms so that my viewers understand why that makes sense?
So I will try to explain it. Let's say you buy a rolled on product of 2-year maturity. So what happens is that fund invests only in 2-year bonds, and with time, the maturity keeps coming down. The 2-year rate, let's say, is 6%. The 1-year rate is, let's say, 5%. After 1 year, the 2-year bond that you bought at 6%, the residual maturity is only 1 year left. So even if interest rates go up by 100 basis points, that means the 1-year rate today becomes, which was 5%, becomes 6% after 1 year. Even then, you don't make a loss. You earn 6%. And if interest rates do not rise by 100 basis point, you actually make a capital gain. So one is that you get a higher coupon, a higher carry income if you buy into a longer bond. And second is because the maturity keeps coming down by time, you tend to get some benefit in terms if interest rates rise, you don't suffer a loss. So, I mean, this is as simple an explanation I can say right now. So, if you buy into 2 to 3 year kind of roll down products, you will still make, I think, 560, 560. And these are completely liquid products. So they are open-ended FMPs, so to say, and you can take out the money anytime. And unless there is a very sharp interest rate
Yes.
movement, you should not expect loss on your principal if you hold for 6 to 8 months or 12 months at least.
Okay. My last question to you, at what point in the years to come do you anticipate that we can finally move to having a substantial portion of our fixed income in longer term products? Would you say that it's prudent right now to have a majority of your fixed income products, or rather fixed income investments, in the shorter end of the spectrum?
No, I wouldn't say that. I thought that, with abnormally low interest rates in face of high inflation was a time when you should avoid duration. So I think once you see RBI has normalized rates, and by normalized rates, I mean, if expected inflation is 5% and the RBI overnight rate is 5% or 5 quarter, that means RBI is no longer behind the curve. Then at that point, you can start increasing allocation to uh, the 10-year bonds or the longer term bonds and the longer term bond funds. See, just like earnings dictate equity prices, inflation and inflationary expectations dictate bond prices. So once we see that the central bank is concerned about inflation, is not following policies which are likely to increase inflation, that is the time when you should shift to longer term bonds. But at the same time, I would like to say that, once things normalize, you have a breakup of your assets into various buckets. Have, let's say, 25% into longer term maturity, 25% for, liquid plus kind of 25% it could be in corporate bonds or banking and PSU debt funds. So simply like this, you can break it up and depend your liquidity and tax benefits and your regular income requirements will all be met.
Understood. Thank you so much, Sandeep, for taking the time. I believe, like me, you are slightly under the weather. So here's wishing you a quick recovery. And thank you so much for taking the time.
Same to you, Alex. Bye bye. Thank you.